Many people pick an ETF the same way they pick a protein bar. It's packaging, hype, good vibes. Let me show you how to actually pick one with a little bit of work so you won't get tricked. I'm Brian, CPA, over 15 years in finance. Vanguard is a gold standard on many low-cost index ETFs. iShares has a lot of great options too. There's many other good funds, but even with the big brands, you still have to look under the hood, read the label to know what you're getting. Many will ask, is this a good ETF? Here is a literal 5-step checklist. I run it every single time. It takes about 3 minutes. So VUN, for instance, 0.16%, that's $16 per year on every $10,000 invested. Excellent. Now look at ZWC, 0.72%, it's $72 per year, 4.5 times more expensive. The rule is under 0.25% is very good. Over 0.5, it has to be very, very high quality at that point for me to invest. VUN holds 3,700 companies across the entire US market, small, mid, and large cap companies, real diversification. ZWC, on the other hand, holds 6 banks, much more concentrated, higher risk. You're paying a higher fee for less diversification. If you're paying a fee, you better be getting real diversification. Otherwise, why not just invest in single stocks yourself? VUN pays about 1.3%, clean growth, mostly capital gains. ZWC shows 7% yield. If you only look at the yield, it looks amazing, but a lot of that is actually return of capital. So it's your own money getting mailed back to you. A little bit more nuance than that. It's the net asset value returning to you. But if you look at total return over 10, 20, 30 years, low-cost broad ETFs usually win by a large margin. Yield is not the same thing as total return, especially with these covered call type ETFs. Quick check, so both have over $100 million, so they're safe and liquid, but VUN tracks its index almost perfectly. ZWC lags the banks by about 2% a year. That's the covered call gap on your upside. Over decades, that gap can grow to tens of thousands of dollars. Here's the truth. VUN is an A+ core ETF for long-term growth and buy and hold. ZWC is built as an income product. It's higher yield, lower growth. If you know that going in, it's fine. I'm not trying to rip on this ticker here. It's just dangerous when people think they're buying a somewhat similar product. Personal finance is personal. For a 35-year-old, let's say, trying to grow wealth, VUN makes a lot more sense. For a 70-year-old who needs monthly income, maybe ZWC fits her portfolio and risk profile based on other shares. Point is, you can run this 5-step checklist on any ETF in just a couple of minutes and instantly see if the story matches the math. If this was helpful, please like and subscribe for more content like this.